If you're looking to begin investing in 2026, you might be researching platforms right now. And if you just so happen to be researching Vanguard, then how fortuitous that you come across this video because we are going to do a deep dive on Vanguard today. And the idea behind this is to give you an overview of Vanguard, what they have to offer, help you understand all of the options that are there, and lastly, how to pick the right one for you. Now, if you do get value from this video, this is the kind of stuff that we are going to be doing in the community where we're going to give you a 12-month support package. So if you go through this, you get value and you think, I could definitely do with some support, then what I suggest you do is join the wait list. The community actually launches at the end of this month. So you can get into the wait list and get on the communication list for when we start announcing what we're going to be releasing. I might do a little something on the video here, but join the waitlist so you don't miss out on the offer. We're going to have founders offers and discounts and all that kind of stuff as well. Yeah, the link is going to be in the description down below. All right, so now that is out of the way, obviously this is going to be a bit of a longer video, so grab a drink. I've got mine here. Grab a notepad as well. Take some notes. You can obviously pause this video. You can come back to it. You can speed up. You can slow down. Do what you need to do. But hopefully this will help you as much as I know that it's helped other people who have actually gone through this with me in private cohorts over the years. Now, let's just get started with the full presentation. So I've called this the Vanguard Made Easy workshop for beginners. And that isn't to say that if you are kind of like a novice where you've started to use Vanguard, but you found yourself guessing yourself and not really understanding the options that you are choosing, you're probably going to get some value from this as well. But it is aimed at beginners specifically. Okay. Right. So a little bit about me. For those of you who know me, this is not going to be news to you, but if you're finding me for the first time, this is my 6th year on YouTube. But my career in financial services actually spans 18 years. So I started in retail banking, where I was doing credit cards, overdrafts, working with personal loans, opening accounts, so on and so forth. I then went from retail banking to corporate banking, where I was helping businesses fund equipment and machinery. And then I went into wealth management, which is where I worked with investments, bonds, pensions quite a bit. And whilst I was there, I qualified as a financial advisor and a mortgage advisor. Now, I did write a book in 2023 called The Money Basics: How to Become Your Own Financial Hero with HarperCollins. That was a bestseller. That was a dream come true for me so early in the YouTube journey. But I guess it goes without saying that I am no longer a financial advisor because I don't advise on investments or mortgages anymore. I've done quite a lot of TV work over the years, and these are just some of the TV shows or channels that I've been in. I couldn't fit them all in here, and I've been in quite a few newspapers contributing in terms of like opinion and views and just general commentary. But that's enough about me. I've already covered a little bit about the agenda, but just this is what we're going to cover just to reaffirm it. We're going to do an overview of Vanguard. We're going to have a look at the offering. We're going to help you understand the options that are available, and then how you go about picking the right option for you. So let's just jump straight in. Before we do that, though, disclaimer. Now, I am a qualified financial advisor, but I'm not your financial advisor, okay? So it should go without saying that this is not financial advice. You should use this video as an educational piece, a piece that will hopefully give you more information so that you can do further research. This is not meant to be financial advice. So please just bear that in mind, especially when I start talking through maybe some scenarios, so on and so forth. Okay. Now, overview of Vanguard. The gentleman in the picture here is John C. Bogle. Now, John C. Bogle is actually the founder of Vanguard. Vanguard was founded back in 1975, and it now manages over £6 trillion in assets worldwide. I think the only other provider that is at that level is probably BlackRock, I believe. And Vanguard are known for being the pioneers when it comes to low-cost investing. That was almost like their ethos when they first started out, was to be the pioneers and the front runners in terms of providing investment vehicles to the general public and to the professional industry at low cost. And through my years as a financial advisor working in wealth management, certainly sat in investment committees and working with investment managers, you would often find that even the professionals will use Vanguard funds in a portfolio. In fact, if you have a financial advisor, it's likely that you have a Vanguard ETF or index fund in your investment. And I think that's quite nice because in today's land, you can go directly to the source and get what a financial advisor would put into the portfolio. The know how is obviously what you pay the financial advisor for, and the expertise that they can provide, which can be very, very valuable. But if you're just starting out, you don't necessarily have the money or the investable assets for a financial advisor. Vanguard is a great place to begin as one of the options that you might be looking to explore. Now, what is the Vanguard offering? They have different things that they offer. Broadly, there are two things, okay? So the first one is ready-made portfolios. Then the second is kind of like a build your own service. And we're going to dive into each of these through the course of this video. But let's start with the ready-made service portfolios first. So you've probably heard of the Vanguard LifeStrategy Funds, and you probably heard of the Target Retirement Funds. These are the two ready-made portfolios they have. They are designed for different things. Okay, so as you could probably as you can probably see here, the Target Retirement Funds are funds designed for people who may be looking to retire at a particular date, and they're built specifically to do that. Now, when you use the ready-made portfolios, it's really important to understand that they're actually pre-constructed portfolios designed by professionals from Vanguard specifically. And what they're designed to do is to match the various risk levels or financial goals of the individuals who will be buying them. The portfolios typically consist of a mix of different asset classes, we call them. So you've either got stocks, shares, equities. Stock, shares, and equities are the same things. And then you've got bonds. So bonds are typically corporate bonds or government bonds, okay? And they're effectively managed on your behalf in these ready-made portfolios. Now, who is it for? It's for investors who prefer not to spend time managing their own investments and would rather have experts do it for them. So you're taking away a lot of the thinking, you're taking away a lot of the worrying that would come with managing your own investments. You've got someone who's built something that's ready to go for you. Now, there are clear benefits to the ready-made portfolios. I've already mentioned ease of use. There's no need to choose, your own individual funds or to rebalance your portfolio, which we'll talk a little bit about. You don't have to worry about diversification. The portfolios are already diversified across equity, stocks, shares. Again, those are the same things, and bonds. And then you've got professional management as well. So the Vanguard's teams will regularly monitor and rebalance the portfolios to maintain the desired risk levels. And it's very, very simple if you're just starting out, you want to invest where you don't have to do any of the thinking. Now, on the build your own side, this is where it can get really confusing for people. Okay, so you've got index funds and you've got ETFs. I think the main thing to note here is that index funds and ETFs are very, very similar. What these are invested in are companies, so stocks, shares, or equities. Again, those three terms mean the same thing. These will be companies traded on a stock exchange. So this will be Tesla, Amazon, Meta. This will be Coca-Cola. This will be Walmart. These will be those types of companies, okay? So they're traded on the stock market. And when you think about how investments are built, equities, stock shares are the engine of your growth effectively, okay? This is where you're going to get the most bang for your money in terms of your money working hardest for you. But they also carry risk because depending on a number of factors and how the companies perform financially, you may see the value in the business, the share prices fall and rise. That's just the way the markets work. So index funds and ETFs are very, very similar. We'll talk a little bit more about those later on. Then you have bond funds. So again, bonds will be corporate bonds, government bonds, but in a fund. Now, because bonds are typically IOUs, i.e., you give me £10,000 and over 2 or 3 years, I will give you back your £10,000 with a return. Whilst they are safer because there is a known return, because this is a fund, it's also traded. So that means that sometimes you will see the value of the bond fund fluctuate, but they shouldn't fluctuate anywhere near as much as the index funds and the ETFs. Again, we'll talk a little bit more about that later on. So, building your own. This service allows you to create and manage your own portfolio by selecting individual funds from Vanguard's broad range of offerings. You get full control over which funds to include, how much to invest in each, and when to rebalance. That might all seem like gobbledygook right now, but we'll explain all of that as we go through. Now, who is it for? This is for investors who want more control over their investment choices and are willing to take a hands-on approach to managing their portfolio. I think this is really important. So if you're just starting out, and again, this is a workshop for beginners, if you want a hands-on approach, then using their build your own offering, if you will, is going to be perfect for you, but you need to know what you're doing. On the other hand, if you're the kind of person that you're just starting out, you don't really understand how investing really works, and frankly, you're just going to be busy with family, work, business, career, health, gym, just living life, then maybe this isn't the right route for you to go down. You may want to go into one of their ready-made portfolios, okay? Now, benefits, customization, because you get to choose exactly what you want and how to allocate your money to them. You've got choice. Vanguard does provide a wide range of investment options, including the index funds, ETFs, and actively managed funds as well. We'll talk about those a little bit later on. One thing I will say is that there is huge learning opportunity here, and this may be something that you embrace. It may be something that you don't necessarily want to embrace. As I've already said, you kind of need to know what you're doing if you're going to go down this route, investing and control. You get to decide how much of your portfolio to allocate to different asset classes, be that equity, share, stocks. Again, those are the same things, or bonds broadly. Okay, you get full control, and I think one of the attractions of this offering from Vanguard is that oftentimes when I do a lot of coaching, oftentimes when people come to me, they will come to me with the understanding that, oh, I've heard of Tesla, I've heard of Amazon, I've heard of Meta or Google or some just company from YouTube or from social media. I want to put money into that thing. And you can go and buy individual stocks, but that is very, very high risk. Within this, you're not going to get the ability to choose the actual individual stock that you put your money in. But what you will be able to do is you're going to be able to put your money into a broad collection of companies that are traded on the stock market. And to be honest, when you look at what companies are included in the Vanguard portfolios, most of the companies that you would want to be invested in are in these portfolios. And that sometimes comes as a surprise to people. But again, we'll show you all of that a little bit later on. All right, so understanding all of the options. Let's start with the LifeStrategy Fund, shall we? So, LifeStrategy Funds, they provide a simple, diversified mix of global stocks and bonds tailored to different risk levels. Now, they offer automatic rebalancing to maintain their chosen asset allocation, making them ideal for long-term hands-off investing. Now, if you don't know what asset allocation is, I'm just going to give you an example of that now in this explanation. So if you zoom in here, we've got 3, I believe, of the 5 LifeStrategy funds that Vanguard currently offer. You might notice that the number here is different on each of them. So you've got 20%, 40%, 50%. Okay. Now, what does that mean? When you come to this circle down here, what you'll see is that they have 20% in shares, but they have 80% in bonds. That essentially is asset allocation. It's how you allocate money to a particular building block within an investment. So with Vanguard specifically, they only have shares and bonds as part of the building blocks. There are more than those two, by the way, but these are the two that Vanguard predicate their investment funds on. Okay. So the asset allocation here is a 20% split to shares, 80% split to bonds. In the 40% one, well, it's 40% equities or shares, 60% in bonds. And over here, you've got 6% in shares or equities, 40% in bonds. Now, these three will be suitable to different types of people. So, broadly speaking, when you think about investment theory and you think about when you want to invest, one of the most important questions you need to ask yourself is, well, how long are you going to be investing for? Are you investing for 10 years or 15 years or 5 years? Because depending on the answer to that question, well, that's going to determine which of these is likely going to be suitable for you. General rule of thumb is that if you're investing for less than 5 years, you shouldn't. You need at least 5 years. And on a spectrum, in this example, if you are investing with say 6 years on the clock, you probably will be better off in this portfolio, this particular fund, than you would be here in the 60% one, because the amount of exposure you have to shares represents too high a risk for the term that you're going to be investing for. So the ideal scenario when you look at investment theory is the longer you have to invest, the more risk you can afford to take. The shorter the time you have to invest, the less risk you should be taking. So that's just a kind of a really high level breakdown of the LifeStrategy funds and what we mean by asset allocation in this example. Like I said, there are two others. I think there's an 80% one and there's a 100% one also available within Vanguard. And again, which one you choose will be predicated on how long you're looking to invest and some other factors which we'll talk about shortly. Now let's have a look at their target retirement funds. Now, these are designed to simplify retirement investing by adjusting the mix of stocks and bonds as you approach retirement. So these funds automatically become more conservative over time, offering a hands-off approach tailored for to your retirement date. So this really is for people who are investing with retirement in mind, right? So let's just take a look at examples here. So this particular one right here is a target retirement, and the target retirement date is 2035. So if you're the kind of person that is looking to invest right now and you know that 2035 is when you want to retire, this might be perfect for you. And as you can see, like the LifeStrategy funds, their shares and their bond makeup is different. So this one's got 66% shares, 34% bonds. This one, which is got a little bit longer on the clock, 5 years additional on the clock, has got 71% shares, 29% bonds. This one is 2040, has got even more, 76% shares, 24% bonds. So even within this construct right here, you're seeing this idea of time, and more time means that you can take more risk, because that's exactly what they're doing here with, you know, a shorter period. So this is the shortest one here. You're taking less risk, but as you have 5 years added on, they're upping the risk by having more allocation to the share side. You can see that in these three examples right here. So those are the target retirement funds. What they basically do, they do something called lifestyling. And what lifestyling is, it's kind of explained in this paragraph right here, where it says that these funds will automatically become more conservative. So what happens is, as you get closer to your 2040 date, what will happen is it will start taking money out of the shares and putting them into the safer bond asset or investment fund, if you will, because the risk that you carry in shares is more than the risk that you carry in bonds. So what it tries to do is it tries to protect you, and it tries to protect your investment value, your gains, your retirement projections in income by de-risking you out of shares as a riskier asset than the bonds. Okay, so both the life strategy and the target retirement funds are built with equity and bond exposure. Okay, but why? You've probably already got the answer to this. As you can see here, they are very, very different in terms of their exposure. Okay, but why is that? You know, they're built for different purposes. So we've already explained the target retirement fund date has a date in mind. So what they want to do is they want to give you the best chance to be able to grow your funds, but they don't want to let that risk be overextended as you run closer to your retirement date. Whereas with the life strategy funds, they were always going to keep whatever equity portion you chose when you started. So, just as an example, it doesn't matter what happens, this life strategy 40% equity fund will never have more than 40% equity in it at any given time. If it happens due to growth in your portfolio, they will trim it. That's called rebalancing. But Vanguard will do that on your behalf automatically. So they're built for different things, built for different purposes. Now, we've spoken a little bit about equities and bonds. They help manage risk through diversification. All right. Now, the word diversification can seem really, really scary. So let's just look at how that kind of works. Now, the way I would see this is, you know, if we had a seesaw, right? You've got equities on one side and you've got bonds on the other. Okay. And the idea is that in an ideal world, and I say an ideal world because the world is far from ideal right now. In an ideal world, you would use equities and bonds to balance your risk. Okay. So you'd have like a really nice balance between the two. And the idea is that, you know, when equities, this could be considered a more balanced portfolio as it currently is right now because the seesaw is level, right? So in an ideal world, you're looking at a balanced risked portfolio here because there isn't one that's higher than the other. So if we look at it from a mathematical point of view, you might have 50% equities, 50% bonds. Okay. Now, what we might also see is we might see a portfolio that has more bonds than equities. Okay. So in this example, this would be considered a low risk portfolio. So think back to the Life Strategy 20. This is essentially what you're looking at here in visual representation. Lower equities, but much higher concentration in bonds, which will be considered the safer asset. Okay. Let's look at another example. So if we have more equities than bonds, what that basically means is this is a more high risk portfolio because you have more in equities, which will be the engine of growth. So you're taking more risk than you are in the previous one where you have, you know, more bonds. So this is a higher risk portfolio. And it's worthwhile just noting that when you take a higher risk in a portfolio like this, yes, you have the ability to potentially make more money, but you could also lose more because this kind of portfolio is going to be very volatile or fairly volatile because as the price of equities, these companies that are traded on the stock market go up and down, you are going to see that reflected because you have majority equities in your portfolio. So what risk level are each of these? And this again, this is just a little bit of a test for you here, okay? So I kind of gave this away. So if you look at the Life Strategy 20, the Life Strategy 80, and the Life Strategy 60, if you had a look at a low risk, a medium risk, and a high risk portfolio, where would you class each of them? Give you a minute on that. Clearly, this will be a low risk. This could be argued to be a balance risk, and this would be a high risk portfolio. And again, you'll know this by looking at the share or equity portion in the illustrations or in the funds that you basically select. So, in other words, the more equity you have, the higher the risk. The more bonds you have, the lower the risk. All right. So, That's just a way to sense check your understanding and check this out in Vanguard, which we'll get onto a little bit later on. There we go. Those are the answers. So your target retirement funds, these can be a good fit for pensions. I've already mentioned, but it's important to keep in mind that they are target date funds and automatically adjust your investment over time, which has both advantages and disadvantages. Okay, so the advantage is that it doesn't leave you to be overexposed in equities or shares as you are running up to your retirement date. And the reason why that is important is because let's just say you are looking to retire in year 2040 and you have, 71% exposure to shares, but in year 2039 the markets take a dump for 25%. If all of your money is still in shares, so you've still got 71% exposure to shares, you're likely going to lose a significant amount of money that you're going to need in a year's time with very little opportunity for that money to be recovered in the markets in due course. So what this target retirement fund will do is it will start to take you out of equities into bonds to reduce your risk. Now, the disadvantage to that is that potentially it means that if the markets do the opposite to what I've just described, where the market continue to grow, you're not getting the upside. But this is one of those things that you're going to have to square off and be comfortable with as part of using these target retirement funds. It swings and roundabouts, which is where oftentimes we would always recommend that you're constantly reviewing your retirement investments in the run up to your retirement day, at least I would say maybe 7 years beforehand, just to make sure that you're on track to make your retirement goals with the income that you need to generate and the money you have invested. Really, really important to remember. So, pros and cons, I've already covered some of these, in the target retirement funds. Automated risk management, it's simple, it's hands off, it's built in diversification because you've got a mixture of shares and bonds. Cons, one size does not fit all. So there may be some people who want to have a little bit more exposure as they run up to retirement. You won't get that actually within the target retirement funds. Potential of underperformance because of the converse that I described. If the markets are booming and you're not participating as much as you were in shares, you're going to see that you're not making as much money, and there's limited flexibility because these things are part of the ready-made portfolios. You can't change them. You don't have the power to change them at all. Now let's get on to build your own. And this is always very, very interesting. Okay. So Vanguard is best known for its range of ETFs. So ETFs are exchange traded funds. Now, what does that mean? It's basically a fund that is traded on an exchange. It could be the New York Stock Exchange, it could be the London Stock Exchange, it could be the exchange in Japan, but it's a fund that is traded on an exchange. Now, if you look at things like the S&P 500 and others, they've gained significantly, in terms of the performance, and because of that, in popularity with a lot of retail investors. So I've taken the S&P 500 ETF that Vanguard has here as the prime example. They also do have index funds. Obviously, index funds are slightly different to ETFs because, well, predominantly, oftentimes ETFs are much cheaper than index funds. Yeah, because of the way they're built, and oftentimes with an index fund, you don't have as much flexibility in terms of the trading. So with an ETF, one of the big advantages beyond the fact that they are typically more cost effective than index funds is the fact that it doesn't matter when, as long as an exchange is open, you can sell or trade your fund. Whereas with an index fund, you often have to wait until the end of the trading day for your request to sell to be executed. That can be a limiting factor with index funds. Whereas ETFs, as long as the exchange is open, if you want to, execute a trade, sell at 10 o'clock in the morning, you can do that. It will execute in the soonest opportunity. Then you've got bond funds, which we're also going to talk about in a moment, okay? Now, why are ETFs so popular? We're going to focus on ETFs here. Again, I've kind of already mentioned this. It's because they are low cost, They're quick and easy to trade, and they give you access to a really awesome list of companies to invest in across not just the US in the S&P 500, but across the world. And they offer really, really good opportunities to diversify your portfolio across industries and across different geographical locations. So again, US, Europe, the UK, um, Asia, China markets, Japan. It gives you the ability to invest globally and diversify what you're doing. Now, picking the right one. This is often where people get really, really caught up. All right. So I think it's really important to take a step back and think a little bit about fundamentals here. Okay. So I've got goals and time here written down. And the reason for that is because whenever you're investing, you need to have a clear goal. Okay. So are you investing because you want to retire and you have a retirement date in mind? Are you investing because you need your money to grow for, I don't know, school fees? What is your goal? Being very, very clear on that. Your goal is going to inform your time. So, how long are you going to be invested in this thing for, right? Now, if it's the case of retirement, depending on your age, you may have 20, 30, 40 years on the clock. That will inform how you go about investing your money in the first place. So, this next slide should reiterate something that I mentioned a little bit earlier on in this presentation, okay? And that is if you have less time, ideally, you'd be taking less risk with your investment choices and how you invest. Whereas if you have more time, you can afford to take more risk with your investment choices and in the way that you choose to invest. Fundamentally, that's really, really important to remember. Now, what I want to do is let me just shuffle my screens around really quickly because I actually want to go into Vanguard itself, okay? Now, if you've ever gone into Vanguard, you will have come across all of these options. So in their funds here, we have the life strategies that we've already spoken about here. So you've got the 20%, the 40%, the 60%, the 80 and the 100, okay? They've got some new ones here as well. So this one is a life strategy global equity fund again, but they are still going with 20, 40, 60, 80 and 100. Now, fundamentally, the key thing to remember when you're looking at the life strategy fund is equity exposure here, because that tells you how much risk you're taking and what your allocation to equities or shares will be versus your bonds. And again, if you have more time to invest, so 20, 30 odd years, it may be the case that you decide that you want to be in one of the higher equity options rather than one of the lower ones if you only have, say, 5, 6, sub 10 years to invest. Then you've got things like the target retirement fund. So they've got one here for 2015, which is not far from now. And as you'll probably be able to see here, again, talking about time, risk, exposure to that risk, they've got 30% exposure to equities with 70% in bonds. So again, because 2015 is close, they're taking less risk, giving you less access to the riskier asset, giving you something a little bit more secure. And you can see the different levels or different types of target retirement funds they have here. I think the longest one, what's the longest one they have? The longest one they have is 2065. And this one, as you can see, has got 80% equity in it. They've capped these at 80%, even at 2060, it's still 80%, 55, 80, 50, 79. So again, they coincide with the length of time you're looking to invest for. Let me comment something that really, really confuses people. There are so many options here, okay? Now, what I thought I'd do is maybe just highlight a few things that are worthwhile you making sure that you take a look at whenever you're looking to select any of these options, okay? So let me just find the most popular one that everyone always talks about, which is the S&P 500. We're going to have a look at that. And then we're going to have a look at one of the other ones as well. Where is it? The S&P 500. There are so many here. I should actually, here are some filters. You can use filters. You want to go USA here, show the 5 funds. Okay, so this is the S&P 500. Now, when you are selecting this, I think the main thing to remember is this. This is 100% invested in shares. There is no bond allocation to this whatsoever. So all of a sudden, this is a high risk investment. And you can see this by looking at this thing right here. So the risk level is a 6 out of 7. Okay. Now, it's got 515 companies in here. And this is the ongoing charge, 0.07, which is why everyone loves this. And when you think about the companies in the S&P 500, they are big multinationals, but they are American-based or America-founded companies, right? Now, what people often don't do is they don't look at the fund details. And if they do look at the fund details, they don't know what they're looking at. So let's have a look at the fund details right here. Now, this will tell you straight off the bat, okay, that there is an accumulation option of the S&P 500 and there is an income option of the S&P 500. The question is, when do you want the income version and when do you want the accumulation version? You would want the income version if you're looking for dividends to be distributed to you. It says it right here, okay? It says it right here. Now, this would be suitable for you if you're maybe retiring and you need the income. I would hazard a guess most people who are watching this right now, who are perhaps in your 30s, maybe 40s, 50s, early 50s, you're not at that stage of retiring right now. So I would hazard a guess that accumulation could possibly be the better option for you. Why? Because it reinvests any dividends with the aim of growing your investment over time. So this is where you start to benefit from compound interest, because as the companies that pay dividends within your portfolio, it's not just being parked in cash, because that's what happens if you have it in the income version or the distribution version. You have the money sat in cash. That money then doesn't have the ability to grow with your main capital that you invested. So really important, something to remember. Now, we've already pointed out that this is a 6 out of 7 in terms of the risk. What a lot of people don't do is they don't pay attention to this. Okay, so this is the objective of the fund. So the fund employs a passive management or indexing investment approach through physical acquisition of securities and seeks to track the performance of the Standard & Poor's 500 index, which is effectively the S&P 500. Now, the main things to remember here is it's a passive investment. So this isn't an active approach. Now, with passive investments, they are often low cost, which this one is, because with an active investment, which is the opposite of what this is, you will have a team of people. So, for example, right now, I'm recording this whilst we have a conflict in the Middle East. Active investors right now, or active management, will be looking at their portfolios and seeing where there might be risks and opportunities. So in other words, they might identify that there is a particular sector that is at risk of the conflict in the Middle East right now, and they might be taking money out of that sector and putting it into another sector that could potentially benefit from the conflict in the Middle East right now. With a passive investment like this particular one, you're not going to get the benefit of that, hence why it is low risk. So understanding whether or not you have a passive investment or an active investment is important. Now, it says here that the index is comprised of large-sized company stocks in the US. Now, it tells you the fund attempts to, number one, track the performance of the index by investing through physical acquisition in all, or subsequently all of the constituent securities of the index in the same proportion as the index. Where not applicable, to fully replicate the fund To fully replicate, I'll need to get the commas in here. The fund will use a sampling process to remain fully invested, except in extraordinary market, political, or similar conditions where the fund may temporarily depart from its investment policy to avoid losses. So, with this, it is possible that if things get really, really bad, they might basically step away from um, making sure that the investment matches the weighting within the index itself. You might be asking, okay, so what is the index itself, and what does it actually does this actually look like? Let me just go all the way up here because they moved it. What I'm looking for now is I am looking for. Oh, they moved it. I am looking for portfolio data. Let's go in here. Okay. So what this is telling you here, and this is worthwhile looking at for any of these that you would pick up, by the way. This is just an example, but you would do this for anyone that you're considering. Tells you number of stocks, and when you go down here, it will tell you this is North America. So this is predominantly the USA, mainland USA, right? So North America, you don't have any companies in this index, in this fund outside of North America. All right. Now, you might be asking, what kind of sectors? So when we talk about sectors, we talk about industries, okay? So when we come down here, you can see the weighted exposure. And what weighted exposure effectively means in this example is how much of the portfolio is exposed to each sector currently. So IT, so this is the tech sector, okay? So at the moment, what we're seeing here is that there's 34% invested in tech, in the tech sector. In the financials, which will be the banks, which will be the likes of Bank of America, for example. You'll see the companies in here in a minute because they are all listed. There's about 12.9% in financials. In communication services, 11%. In consumer discretionary, 10.4%. Healthcare, 9%. Industrials, 8.6%. And it goes on and on and on and on and on. And you can have a look and see how the portfolio is fully constructed and what the allocations in each of those industries or sectors looks like. Now, you can have a look at the companies, and from an individual company level, how much of the portfolio is invested in each company. So, for example, okay, up here in tech, there's 33.4% of the portfolio invested in this sector. And so when you go to the holdings, all of these are tech companies in the top. What is this? The top 1, 2, 3, 4, 5, 6, 7, 8, 9 or 10. 10 or 11 companies here, right? These are all tech. So how much money is invested in each of these companies from within the tech industry? So NVIDIA, they're very, very big right now in terms of chip manufacturing. They're selling like hotcakes because of this AI race. They provide components for all of the tech to exist in terms of the chip supply. So they have got the largest allocation as a company, 7.82%. Apple, 6.45%. You've got Microsoft, 5.3%. And by the way, if you go on to next, you can go and have a look at how this money is distributed across all of the 503 companies in this index. Now, it's not that you have to know this stuff, but I think sometimes if you are trying to learn and you're a sucker for the detail and you want to know what kind of companies your money is going to be going into, this can be very, very useful indeed. I encourage people to go and have a look at this so that you can kind of get a feel for what kind of companies are included. And the reason for that is, investments will go up and down, and that's just the reality of things. But if you get to know, for example, that one of the biggest companies that you have money in is someone like Apple, for example, you can easily then go and do a little bit of research on Apple and its financial strength. Apple, I don't know whether they are still the richest company on the planet, but once upon a time were. They have a lot of cash. So because of their size and because of their financial strength, you could argue that it doesn't matter what happens from a global economic point of view, they have enough cash in the bank for the company to continue to survive past any economic or global turmoil. And I think that's very important in terms of having comfort when you're investing for the first time as a beginner. So you can look at all of the details in the portfolio here just for your own kind of peace of mind and just for your own education as well. You can also go and have a look at, some of the performance. And this is actually available on the home screen as well. But you can have a look at the rolling year, for example, and you can go back, all the way back to 2021 here. You can see how this particular fund has actually, performed. In 2021, you're looking at, by the way, the red mark here. So this is the net asset value. So it's what it's done net of all charges. 16.07% in 2021. Obviously, we had COVID in 2020. So it took a bit of a dip. And the benchmark will be something that's very, very similar to this fund. So in this year, it's outperformed the benchmark, or its benchmark, a little bit, not by much, 16.07 versus 15.9. But equally, in a bad year, it only fell 7.97%, whereas the benchmark, a similar one, fell at 8.6%. So you can see the performance over a 5-year period. And obviously, past performance is no indication to future performance. But what you can also do, if you can actually look at it on here, is you can have a look at how it's done over a 5-year period, right? So you can go back a little bit more to see, okay, what's the trend of this investment? And again, it's not an indication to future performance, but it can give you confidence in, okay, has this thing performed well? Is this thing that I'm putting money into performed well on its own, despite what happens globally? If you go back 5 years, 91.49% since the inception of this particular fund, that Vanguard's version of this fund, 164.68%. So you can go back and you can play with some of these numbers and you can look at the way they performed. One thing I would say is it's definitely also worthwhile looking at the cost and minimums here. So you're seeing the ongoing charge here. The minimum to invest is £500 in this one. Minimum monthly direct debit is £100. And it will just give you, based on the ongoing charge here, what that would compare to with an average external fund if you went elsewhere rather than using Vanguard, in terms of the annual cost to you based on a £10,000 investment. This is stuff that is definitely worthwhile paying attention to when you're looking at trying to figure out which or what kind of fund you want to have a look at. I'm just going to go back a couple here because I think it might be worthwhile just having a look at perhaps another one. Let's get rid of this filter. Let's have a look at, what have we got here? What have we got here? Let's look at all of the UK ones that are available. So let's have a look at the FTSE 100. So again, looking at the risk level, this is a 5 out of 7, but it still has 100% equity exposure here. If you go into the fund details, this is a UK specific fund. All right. So it's only got 102 stocks here. Again, you've got the accumulation or the income version of this. You can see the performance right here in terms of how it's performed. And actually look at 2025. The FTSE 100 did pretty well, 27.89%, it doesn't have 2020 data right here, but you would argue this performance isn't that bad for the FTSE 100 here. You can go into the portfolio data, and again, you can see this is from a regional point of view in Europe, but more specifically in the UK. And you can see the split. So this is very different to the S&P 500. So the largest amount of money invested in this particular fund is in financials, 26.7%. And when you come down here, you can see who those companies are. So HSBC has the largest holding at 8.89%. AstraZeneca, Shell, Unilever, Rolls-Royce, 4.13%. British American Tobacco's 3.75%. And again, you can just scroll through and see all of the individual companies that you have. We've not yet spoken about bonds, right? Okay, so let's just perhaps go find a bond fund for us to have a look at. Let me just go one back here and let's do a filter. I did see some bond ones prior. These are equity funds. Okay, before we do that, let's have a look at the active ones, okay? Like I've already described, active means that there is a team of people that, in circumstances like we find ourselves in right now, will be looking at where the opportunities are and where the risks are, and will be shuffling the deck, managing the portfolio accordingly. So let's have a look at, I want to choose a global one just to show you. Um, we've got some bond ones here, which we'll go into in a moment. Let's have a look at this one, which is the Global Equity Fund. So it's 5 out of 7, 95% in shares. Let's have a look at the full details here. Now, how you're going to know, again, it's got the accumulation and the income option here, but how you're going to know that this is an active fund is because it should say in the objectives right here. So again, it's worthwhile just reading through that. But for the sake of time, let's just go and have a look at the portfolio data right here, because this is global. This is going to be invested in other geographical regions. So you've got America, you've got Europe, you've got emerging markets, and you've got Pacific. So what are the countries specifically? US, Japan, Taiwan, China, UK, Canada, Netherlands. Okay. And again, if you come all the way down here, you can see the industries or the sectors. So again, mostly in tech. Then you've got industrials. Then you've got consumer discretionaries, financials, healthcare. And then you can go down to the actual companies that they're invested in. Now, it's no surprise you've got tech companies. Well, the first four are tech companies. I'm not sure who process NVR. I don't know whether they're a tech company or not, but the first four are household names. Okay. Amazon, Nvidia, Microsoft, Taiwan Semiconductors, or TSM. And again, you can go and have a look at all of these. In this, there are how many companies in this particular one? There are 190 companies in this particular one. And again, you can go see all of it. If you want to, you can come back up here and you can go and have a look at the performance. So if you're looking at it over here, you can see back in 2021, actually, compared to the benchmark, this one hasn't performed that well, because 3.06% versus 12.57%. These are the kind of things that you would need to look out for. There may have been a reason for that. In your research, you want to find out why and whether the trend continues, that it doesn't actually meet or beat its benchmark, which this one doesn't seem to. So if you're trying to select this one, the question will be, why is it not beating the benchmark, and what exactly is the benchmark? And this is where it's worthwhile picking up the phone to Vanguard just to ask those questions. Their team are fantastic in taking those kind of questions as well. The charge for this one is 0.48%. And why? Because this one is an actively managed fund. Now, I think it's worthwhile just noting, because something is actively managed does not necessarily mean that it's going to outperform a passive investment. By no stretch of the means does it automatically mean outperformance. Now, it could be that it hasn't outperformed because they could have got perhaps the timing of shuffling the deck around wrong. There may be a real reason for that, but you want to find out why. But it's worthwhile noting, because you are paying more, you need to make sure that you're doing the research over whether or not it's worthwhile paying more for that service, looking at all of the data that you have in front of you to actually make an informed decision. Let's go one back and have a look at, let's have a look at one of their bond options here, just so that we can see how that works. Let's look at this one right here. So on the bond options, what's the big difference that you immediately see? Risk level, 3 out of 7. Shares, 0%, bonds, 98%. Okay. So when you go into full fund details here, you've got hedged accumulation, you've got hedged income. Hedged basically just means that it's taken an opposite position to something else, okay? But again, if you don't need the income, you might want to go accumulation. If you need the income, you might want to go income right here. This has got 432 bonds in it, effectively. Look at the charge, 0.35%. So let's have a look at the objective here. The fund aims to provide a high total return, capital growth plus income than the Bloomberg Global Aggregate Index. After the fees and expenses of the fund employs an active management strategy in aiming to outperform the index, and in doing so, the investment manager will follow distinct approaches in managing the fund's assets. Really important that you read this. So this is, yes, a bond fund, but it's actively managed as well. You'll see in the column here, if you're paying attention, whether or not you can actually put it into an ISA. All of these with Vanguard um, are available to be put into an ISA at any given time. Well, this one actually doesn't look like it has any performance data. This may be a brand new issue where it doesn't have any historical data just yet. Let's have a look. Portfolio data. So this is worthwhile noting, all right? So when you think about bonds, typically bonds are graded. There are AAA, AA, A, triple B, and double Bs, right? If you've ever watched the film The Big Short, they have a section that talks about this in this video in that film. Now, AAA will be when a company has like a very, very, very strong credit score. It's like a personal credit score. If you've got a 99 on Experian, you're a AAA, and that basically means that it's lending money to companies that are extremely financially stable. What does that mean? It means that effectively, when you put money into this thing, the companies aren't going to go bust. I mean, they could, but the likelihood of them going bust is very, 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 very slim. So what this is saying here is that effectively 13.3% of the portfolio is invested in triple A companies. You've got 34.7% in double A. Now, why might that be? Because the rate that you would get from a triple A company, because they have financial stability, you've got more certainty of getting the money back. They're not going to offer as good a rate as, say, a double A or maybe a triple B. Now, a triple B is still relatively strong, but the question is, do the portfolio managers want to invest at that level? Typically speaking, when they put money into triple A, double A companies, those are deemed as really, really, really strong companies. And so you can kind of see how the portfolio is split in that regard here. I think you have a little bit information about credit maturity here. So, they will have different tranches. So you will have some bonds in this where you have the bond maturing within 1 to 5 years, 5 to 10 years, 10 to 15 years. And this is what you're seeing. So what you're seeing here is that 39.8% is going to mature within 1 to 5 years. Then they have some longer ones maturing 5 to 10 years at 37.5% of the portfolio, so on and so forth. They have some over 25-year bonds in here at 9.1%. And you would argue, because you are lending money for a much, much longer time, the promise of return on these ones will be much, much higher as well. All right. So as you can see here, there are some that are government related in here. There are some corporate ones. So again, corporates will be Apple, Tesco, Sainsbury's, big companies. These government ones will be maybe UK government or UK Treasury, US Treasuries. It could be a number of things in here. But this just gives you information that you can arm yourself with to try and understand where your money is going. Like I said, you need to be very curious in understanding what all of this means, because again, I've just mentioned United States Treasuries here, so obviously it's included in the makeup, but you can see there are 279 items here where the money is distributed, right? But again, you need to understand what all of these things are. So what I will say is, let me just go full screen here. What I will say is Vanguard is a very, very good option for you to start. Vanguard is a very good option for you to start your journey with. You've got to make the decision of whether or not you use their ready-made portfolios or whether you want to do it on your own. I think for first-time investors, beginner investors, the easiest route is to perhaps choose something that you can simply access to build some confidence as you kind of gain more confidence and you gain more knowledge, you can go into, some of the index funds or the ETFs that we've walked through here, looking at the information to make sure that you are abreast of where your money is going. It's really important to stress that because you are investing, there is risk. A lot of people on YouTube will tell you that there is no risk. That is a lie. As money goes up, money can also go down. And I think it's really important to acknowledge that. But the fundamentals that we've spoken about here on this video around your goal and your time, and if you have more time, you can afford to take more risk. If you have less time, you should be taking less risk. Those will hopefully give you the grounding to know which of these options that might be right for you based on your circumstances. It will still require you to be inquisitive, to ask questions, to seek out answers. But hopefully, we've given you enough here in this video to be able to take that first step and maybe do a little bit more research. Like I already said, the community launching at the end of the month is going to provide a 12-month package where we're going to help people understand all of this stuff in more depth, but also help you lay the foundation to get into the point where you invest so you can do it properly. Okay? Everybody wants to invest, but the truth is, not everyone is ready to invest. So, how do you get ready to invest in a way that gives you the best chance for success? Not putting money in that you might need, and then you got to take the money out, and God forbid the markets take a bit of a dive when you take your money out, that you lose money, and that puts you off. You don't want to invest anymore. I'm all about giving people the foundation so they can do this properly. And that's what we're going to be offering in the community. The waitlist is linked down below. If you did enjoy this video, do me a favor. Please do click the like button. Thank you so much for joining. And please look, if you stay to the end, please put in the comment section 1%er, because you are a 1%er right now. So put 1% in the comment section and I'll be sure to acknowledge you individually. I appreciate you for watching. If you haven't already subscribed, please consider subscribing. If this is something that you like, I will do more deep dives like this because God knows I have plenty of them. But sometimes this isn't the best place for it on YouTube. So your feedback is going to be invaluable in that regard. Catch you later in the next video. Cheers.